Hi, this is Dan. Welcome back to Invest Rent to Own, where we talk about investment rental strategies to make you the maximum profits. Again, I'm Dan, and welcome to this one, which is what is the market in a bubble? I do not think that the market is a bubble, and I will show you why I do not believe that. I've been investing since 2002. I've seen the market go up, I've seen the market go down, I've lived in many different areas and seen many different markets, and I'm here to tell you that market is not in a bubble. It's quite possible that we have some areas that are showing bubble-like characteristics, but really I believe we're just finally waking up to some expansion that is well needed, and that's why you're seeing a big pop. It's more of a supply-driven concern about supply constraints that are driving prices right now, and less about, and a little bit of buyer demand, of course, but it's really about, not about bubbles or financing that's really driving it. So some slides for you to show you what I'm all talking about. Okay, so this first one is freely available. It's from one of our government agencies. You can find it there at www.consumerfinance.gov. So what I want to show you here, you can see this is the percent of mortgages that are 30 to 89 days delinquent on the national average. So from a national perspective, the last time that we had a big real estate crash was back here in the 2008 to 2010 timeframe. You can see at that point that we had 4% at tops that were in 30 to, so 1 month to 3 months delinquency. And where are we today? Well, this is only current as of March 2021. You see they released this in September, and we are way down here. Way down here. I think that this drop is probably the result of a lot of government intervention, and so we are a little bit low normally, but we are nowhere near where the last time a bubble popped. So another thing that they show us here at the same website, this is the percentage of mortgages that are 90 or more days delinquent. So in this particular one, these are the ones that are likely to get legal action, which will drive something to foreclosure. So you can see again, back when the Lehman Brothers issue happened, back here, we saw a very sharp rise in delinquency rates, up to peaking to 5%, and then it took a while for that. But you can see it continues to go down, 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 down. Again, current as of March. You should pay attention to these to see if there's spikes or rises. I don't anticipate that we will see that just because we've seen so much government intervention, but that's absolutely where you would want to pay attention to if this is something that you're concerned about. I actually think it's a great opportunity. I'm able to turn foreclosures into rent-to-own houses and make great returns. I'm making 60% annual, 100% annual returns, not even flipping, 30, 40, 50 deals a year. I'm planning 50 deals this next year. I did 37 deals so far in 2021. So I think that it's a great opportunity to take advantage of. Some more info here. Okay, so let's think about this. Why do we need more houses? Well, we need more houses because we have a population. So the only way that we'll really get a bubble to pop is if we're building more houses than we have people. So let's look at what really is driving that. And so the population of the United States is typically growing about 1% a year. We did see a little bit of a drop in 2020. That was they anticipate that was because of COVID, that some people just decided to delay having some children, and probably some migratory effects happened there too. And so I would say it's a good guess if we're growing at about 3 million people per year. People buy houses when they get married, they move in together, and or they have children once they've done that. So on average, we should be growing at about $1.5 million or 1.5 million houses per year nationally just to keep up with the normal supply that is needed to fuel our population. Well, here is a chart that shows the housing starts. It isn't as current as I'd like to show, but it's the most current that I was able to find. This shows the drop related to COVID. I'm sure that it has recovered significantly from then, but what you'll see here is, this is on the left-hand side, this is thousands of units started. And so you see that there's 1 million single-family homes and about just 600,000 in multifamily homes that were being. So we were right in parity of where we needed to be for the annual growing people, right? It doesn't make sense to be building a house for a baby, right? You're building a house for when someone's turning in their 20s or their 30s. But you'll also see, because of the rapid drop here related to the last time the bubble burst, we were way below. So if this is what normal should be, we have been underbuilding for over a decade. Underbuilding for over a decade. And what you'll see here, perhaps we were overbuilding. This is the time frame rate of the peak here is 2006. And they began to sharply decrease the amount that we were building at that point. And you'll see that even though we're rising here, it's nowhere at the level. So if it's going to be a supply-driven crash because we're building too much things, then you would expect this to be much higher than it currently is. Not only to this entire gap that we missed in the population that wasn't served here, but overbuilding on top of that. Throw onto that a different factor, the fact that millennials are approaching, or have been now in for some time. The millennials are this age group here, this bow wave of, let's go back. This bow wave of population that's in this period of life right now, from age 39 to age 20. Sound like the prime years that you would want to be moving out of the house potentially, living on your own, maybe getting married, maybe raising a family of your own? They all have talked a lot about this generation and how they tend to be doing things in their lives at a little bit later clip than other generations have. They delay in driving, they delay in buying cars, they delayed in many other aspects of life. But you'll see, even with that delay, they're approaching or are in those buying years. And so that's a key thing to be thinking about, what is driving the demand, again, nationwide for housing. It is them, okay? They're looking for their opportunity. And this is dated as of 2020. Now, I know that a lot of people are talking about, well, yes, there are some constraints to building houses, and that's definitely true. So this is lumber. That is the number one cost that goes into housing. So you have this perturbation that was driven by, it's a COVID-driven supply issue. As soon as COVID happened, everyone thought we don't need to build houses anymore, and so they rapidly scaled back on production of lumber. But then we shifted back extremely quickly to building more because of migratory effects, people wanting to move in different locations that were driven by change in economic conditions, change in jobs, change in safety, all sorts of different reasons. You'll see that this lasted maybe about 18 months, and we're back down to a stable value here. But this alone has driven the cost of new production of houses. And it takes about 2 years from a housing start to an actual housing delivery, just because of all the bureaucracy that's involved. And so when you see these perturbations, they will be felt for 2 years into the future about the prices of new housing. So my thoughts on the whole thing are that this is all the more reason to be buying existing housing instead of buying a new house, because you won't have to pay for these additional lumber costs. And that new house is going to need to cost all that much more in order to keep up with the cost of putting it together. Buy an existing house, renovate it, you're going to be better off. Another interesting factor that you should consider as to whether we're in a bubble or not is the migratory effects. This is the number one thing that drives the price of houses up or down in a particular effect. Migration, people moving from one area of the country to another, or people moving into the country in general. What you see here on the top is a 2020 study of United Van Lines and where places are moving. The yellow is where they're moving out of. The blue is where they are moving into. So people are moving out of New York. They're moving out of California. You see a lot of headlines of people moving into Texas, but all the more, this is on a percentage basis, all the more people from New York, they're moving to Florida. They're going to their retirement locations, if you will. People are moving south is where they are going. People from California are moving to Oregon. They're moving to Idaho. They're moving to Arizona. They're moving to Texas. Okay? Interesting thing. Now, I do primarily my investing in Ohio. And this is on some other charts that I've seen. It's in the bottom 10. But I have found some great returns in Ohio. So even though this is showing a net migratory effect out of Ohio, I'm still doing amazingly well in Ohio. This other one identifies, this chart on the bottom, shows some areas that saw some really big migration gains. And you'll see, again, they're in the same kind of areas here. People moving out of New York into Vermont, out of New York, Connecticut, Massachusetts, into Maine, into West Virginia, all these outskirts areas. Makes sense. Out of the urban areas into the rural areas was the effect of COVID. Another thing that you need to keep in mind is this cycle. It is a cycle that shows you how the prices will go and whether or not we are in a boom or a bust cycle. It's recovery to expansion to oversupply and into recession, particularly with a focus on housing itself. In recovery, we are past recession. Things are growing as far as declining vacancy. This is mostly used in multifamily houses, but can be used in single family as well. There's no new construction because they've overbuilt previously, and so you're not seeing much new construction in an area. You get to the point where there's been enough declining vacancies that the builders have decided it is worth their while to start building. And so when you get into this area here, you start to see new construction happening during this expansion phase. That's what enters into the expansion phase. This is the best market to be investing in because, like I said earlier, it usually takes from the decision of the builders to bring more supply online, it takes them at least 2 years to start to bring that on because they need to file for permits, they need to acquire land, they need to put together their marketing plans, they need to hire the labor, they need to put together the plan that's going to do all of this. And so it just takes time. Expansion is where you want to be in a market. If you will buy at this part and ride this, then you will see some amazing millionaire-making kind of gains in that particular area. So everyone always wants to know where the peak is. Honestly, that's not what you need to be guessing about. What you need to be focused on is, are we anywhere close, or could it happen, or are we towards the front of it? I'm of the opinion that we are towards the front of this expansion cycle for the reasons I showed earlier about the growth in housing. We are somewhere in the front of this area here, and we are very far, I think, from the peak of this. It's only when you see overbuilding that it's the beginning of the end. It's only when everybody is calling you saying, put your last dollar into this area, buy real estate, you're going to make your millions, and even the guys that are serving drinks at the bar or your waitress or waiter are telling you hot tips about where to buy houses. That's when it's time to be thinking about exiting the market. So some closing thoughts. It is my belief that we are not in a bubble. Very few areas of the country are showing these kind of signs that they were being. I do think that we're in expansion, and that is a great opportunity to do very well. And I think that with the continued supply chain issues, that it's going to challenge the new builders in bringing new supply online. And I think that gives us at least a 2 to 3 year run. I'm not calling that the top is going to occur in 2 to 3 years, but I'm saying that as far as I can see through the fog, we still got 2 to 3 years of good investing ahead of us before we need to change our strategy at all. And I'm going to continue to watch the delinquency rates, because if anything is going to precipitate or predict a change in the market conditions, it will be those issues. I'll continue to watch employment. Employment has gotten very robust again. That would be a precipitator as well. I hope that you learned something today. I hope that it taught you a little bit about market cycles. I hope it gave you confidence that you can invest in today's market no matter where you're investing in. There's more details that you can get on the consumer finance website that was earlier. Again, I hope you enjoyed this. Please subscribe to my channel and like this video, and I'll look forward to talking to you soon.